I'm Sebastian St. James. On one of my previous videos, one of my viewers asked, what are your thoughts on BetaShares Harvester? Do you think it's a yield trap? What is ASDA asking about here? HVST, stock code on the ASX, is BetaShares Australian Dividend Harvester Fund, which is what ASDA's talking about. Right, so we got the fund. Now, what is a dividend trap? CDD Cardno Limited. This is just a stock I picked at random. I'm not particularly picking on this company, but it does illustrate the point. Cardno's dividend yield is an amazing, 193%. The market at the moment is 4%. Wow, what a bargain. Or is it? How stable are those dividends exactly? Well, the dividend stability at the moment is 96.6%. Not perfect, but extremely amazing. Okay, good on the dividends, but show me its stock price, say in the last year. Well, here it is. As you can see, it's going up, up, up. Well, yes, I'm impressed by that as well. Is this a good bargain though? Am I going to be overpaying for this stock? Well, the PE ratio, as you can see, is 0.48%. The market at the moment is 14.68. That's an incredible bargain. Price to book is 0.04. The market is 1.57. Yeah, definitely a value stock. Where do I sign? Take my money. But wait, it's a trap. The astute amongst you may have noticed that the 1 year graph I showed you earlier on was actually not a whole year. Here is the 1 year graph. It goes up, up, and oh, goodness me, something happened there. This stock was taken behind the woodshed and given a what for and a how to. And yeah, you can see its stock price there. If you go back the last month, it's dropped again. Something wicked is happening with this stock. The total shareholder returns over the last 1 year, this includes dividends. Stock price plus dividends is minus 61.2%. So it's lost more than half your money over the last 3 years, minus 13.5%. The last 5 years, minus 13.9%. The last 10 years, minus 14.5%. So minus, minus, minus. If you own this stock, you will lose historically. Is there something amazing about this company? Has it had a come to Jesus moment? Well, let's have a look at its latest figures. Its sales this year is minus 4.3. Over the 5 year period has been minus 7.1. No, not impressed with that. Its cash flow has been minus 10.6% this year. Its earnings were up a bit, but yeah, I'm not impressed with those fundamentals. So here is an example of a potential dividend yield trap. It lures you in with the amazing dividend, but you lose money overall. Dividend yield equals dividend divided by the price multiplied by 100. That's the percentage. So if a dividend is $1 per share, the price today is $100, your yield is a measly 1%. But if the price crashes tomorrow down to $10, then the dividend yield for the same dividend magically becomes 10%. Oh, well, that's interesting. High dividend yields are caused by either earnings are high, which is a good thing, or the price is low, which is a bad thing, as you can see in this example. In this stock's case, which is it? Is it that the earnings are super high or that the price has crashed? Well, we know the price has crashed, but dividend yield does not in and of itself tell you whether it's high earnings or whether it's a low price. We've seen in this particular example what's causing it, but you'd have to go in and research the individual company you're interested in. HVST, this is the BetaShares Australian Dividend Harvester Fund. This is what the question is all about. Notice it is a managed fund. Interesting, aren't we expecting an ETF? Yes, we are, but this is actually an exchange-traded managed fund. Are they all managed funds? No, they're not. Here, by the exactly same company, by BetaShares, is the A200. You will notice it has the word ETF afterwards. It does not have managed fund. So what is the difference? Well, I can tell you. This is straight from BetaShares' own website. Here we go, using their own words. Managed funds are usually actively managed to try to outperform a benchmark's index, right? ETFs are mostly passively managed and they typically aim to track a benchmark's index. Right, managed fund means managed as in active. ETF means passive. Well, kind of. Really, not necessarily. It used to mean that, but nowadays ETFs can actually be actively managed funds, but that's their definition. Managed funds tend to have higher management fees to pay for the skill and the experience of the fund manager versus a traditional passive ETF which aims to track the benchmark index only. So the theory here that a real-life group of managers are worth paying for because they're using their smarts, whereas a passive ETF, well, that's just passive. Any old donkey can do that, therefore we should charge a lower fee. That's the theory. Does it work like that in reality? No, not necessarily, but the higher management fee, yes. That part is true. The A200. Okay, what is the A200? Well, it's a BetaShares fund, which is why I chose it. It is the top 200 ASX. So the ASX 200, no, it's not. It is the largest 200 stocks on the ASX by their definition, but it does not follow the S&P's ASX 200 necessarily. Why? Well, if you follow an actual index, you have to pay. It's kind of like usage rights. Whereas if you make up your own that magically may or may not be the same, then you don't have to pay. I suspect that is what is behind it. The expense ratio for the A200 is 0.07%, so nice and low. HVST, its expenses is 0.720. Right, that's kind of like 10 times more than the A200. Yes, that is 10 times more than the A200. Wow! Since HVST has 10 times a higher expense, is it going to perform 10 times better? No, of course not. Don't be ridiculous, but that is what the expense ratio is. Do expenses really matter in the greater scheme of things? Well, yes, it does. You can actually read BetaShares' own philosophy on this. This is all coming directly from the same site where HVST is located. The chart compares the investment returns of a low-fee passive ETF, and it uses A200 as an example, with that of an actively managed fund, a pre-return of 5%. Okay, that's 5% in both examples. The management fee is 0.07%, comparing with a mythical typical fee of 1.55. We have 0.72, but the principle is still the same. Over a 40-year period, the lower fee ETF fund would grow to be 68,000 compared to the high fee managed fund's investment closing value of 38,000. So 68,000 versus 38,000. The difference? Well, the only difference there were the fees. And you can have a look at the graph there. In the orange is the high fee at 1.55%. And yep, really, the difference is massive. So do management fees count? Do they matter in the long run? Absolutely. Look at that graph. It's like chalk and cheese. So unless you have an amazingly good reason, always go for the lowest fee option that's possible that satisfies your investment criteria. One thing about ETFs is their accessibility. You can buy or sell units like shares on a stock exchange. With managed funds, no. You typically need to apply through an advisor to get into the fund. However, on the ASX, I can go right now into my broker and buy HVST. As you can see right now, as the making of this video, it is 11.87, and I can buy it just like a stock. Interesting. So yes, it's a mutual fund, but it trades just like an ETF. Another part of ETFs is that you can see real-time intraday pricing, whereas mutual funds, no, you can't. A managed fund may only quote its price, say, once a month. What about HVST? Well, I can go right onto my brokerage account now and look at the real-time prices just today. This is intraday. So once again, we're finding that this alleged managed fund is behaving very much like a regular ETF. If this managed fund looks like an ETF and quacks like an ETF, why not call it an ETF? Well, ETFs have a particular structure. They are an open-end fund as opposed to closed-end, and they have separate structures. This apparently does not. It has more the structure of a mutual fund. It just happens to be exchange traded, but there is a difference between an ETF and a managed fund, so keep that in mind. Has HVST got an amazing track record? I hope so, because it has a much higher management fee. So let's have a look at its performance. Here is the performance of the A200. As you can see on the left-hand side, this is to prepare you for HVST. It has the actual fund's performance. On the right-hand side, it is its benchmark, what it should have had. Where does this index come from? ETFs typically are based on a theoretical index or real index, but a theoretical bundle of stocks with no fees attached to them at all. But when you try to buy and sell stocks, there are actual real fees and the management fees on top of that, which the index doesn't have. In addition, shares really need to be bought and sold, and sometimes it takes a little while, a few days to buy them or sell them when the index changes. Also, you have to get rid of stocks, you have to buy the new ones. All this takes time, but certain ETFs are much better at tracking the index than others, so keep that in mind. So we've seen the A200 and how well it's done. Let's have a look at the HVST. Its 1 month is minus 7.69. Its 3 months is, okay, it's missing a massive amount of data. What is going on? Well, if we look at the inception date, it is the 1st of June 2022. Well, that's like a month and a bit ago, yes? That's how long this fund has been in existence. So it's basically got no performance data at all. Personally, I ignore ETFs without a proven track record. Has this got a proven track record? The answer is no. It's only been around for a month. I would like to see 5 years worth of data before I would be remotely interested. This has 1 month. I have future videos coming out which will analyse in detail other ETFs, so make sure you're subscribed so you don't miss out. If we look at the recent distributions of HVST, we see in the 1st of June 2022, the 2nd of May 2022, the 1st of April, hang on, where are these coming from? Was this fund not only created a month ago, and yet I see distributions going back there for, say, a year? HVST's investment objective and strategy was modified with effect of the 31st of May 2022. What's going on? HVST's actually existed for longer than a month. But they've thrown away their strategy totally, and they've brought in a brand new strategy. If you go on a forum, read about HSVT, say 6 months, a year ago, all that's out of date. Fine, the fund may have existed, but their investment strategy did not. They've basically reset it. They've thrown away everything that they used to do in the past. Effectively, it's a brand new fund, which is why we have that inception date there, because trading on the ASX, it is basically a new fund. So what's changing? The fund is maintaining its core income objective for investors. In other words, they're looking at dividends. That's all that means. To provide regular income comprising dividends and franking credits from a portfolio of Australian shares that exceed the net income yield of a broad Australian share market on an annual basis. The dividend harvest strategy. The question is it worth paying 0.72% for a strategy which is, I'll buy shares with higher dividends? Well, I can do that myself. Let's read on. Going forward, the fund will also aim to provide market exposure corresponding to a diverse portfolio of Australian shares. As a result, the fund will no longer employ a futures-based risk management overlay aimed at reducing the volatility of the fund's equity investment returns. In the past, HVST used future contracts to smooth out the fund overall to reduce the volatility. They've done away with that, and now it's got full market exposure. In other words, they're owning the underlying shares outright. If the market goes up, HVST will. If the market crashes, HVST will, because they're owning the shares outright and they're not hedging with futures contract. So if you go on a forum a year ago and you read how stable HVST is, that's the old HVST. New HVST, no stability inherent within it at all. So if I'm basically just buying into the market and I'm getting no extra stability, what am I paying the high management fee for? Good question. On the website, it says how the fund pursues the dividend harvest strategy is changing with the aim of, underlined, significantly reducing deviation or the tracking error to the broader Australian stock market. This suggests to me in the past they had their index and the reality of their fund, but the tracking error between the two were too great and they're trying to reduce it. So that tells me something about their past. We know about tracking errors, don't we? Because this is the A200, and on the left it shows us the reality. On the right it shows us the actual index, and you can see the tracking error between the two. So HVST, you had a terrible tracking error in the past. You hope to reduce it. By how much, I don't know. I haven't seen any history. What else are you changing? The modifications include expanding the eligible stock universe for the fund's portfolios from the largest 50 companies. So the ASX 50 in the past is all they drew from, to the largest 100 companies. So now the ASX 100 is what they're drawing from. The ASX 200 is considered to be the standard index for the Australian market. The top 200 stocks, this is narrower. HVST is now only choosing from the top 100 stocks. Before they were doing 50. Okay, so they're broadening out, but they're not as broad as the ASX 200. I'm not saying that they're not owning 200 stocks, which they're certainly not, but they're not even selecting from the ASX 200. They're selecting from the ASX 100. So why is BetaShares limiting themselves to only the top 100 stocks? If you wanted the best dividends, you would look further. You would go to the top 300 stocks and seriously look in that entire universe. I mean, the ASX 300 exists. They're reputable companies. If you're really after dividends, you would have a look at the entire universe of stocks. But to limit yourself to the top 200, well, that's one thing. But to limit yourself to the top 100, that's even narrower. What this indicates to me is they're trying to be more like the index. They're not really hunting seriously for top dividends producing stocks. They're trying to be like the index, and within a very narrow field, the top 100, they'll say, oh, now we'll start to look for dividends. Well, yeah, you're basically the index already, and you're not serious about finding dividends, in my opinion. How many stocks does HVST actually hold? That I can tell you. Increasing the number of security in the fund securities portfolio from up to 18, which is what they held previously, that's not many, to approximately 40 to 60. This is a rather simplistic strategy. They're choosing the top 100 stocks by market cap, owning by definition around about half of them, hopefully the ones with the highest dividend paying, but they're committed to buying about 50% of them, and that's it. That's their strategy, right there. Maintaining a sector-neutral securities portfolio relative to the broader Australian share market in each portfolio rebalance. The ASX has sectors like energy, mining, retail, etc. The Harvester Fund wants to be like the broader index. In other words, it wants to choose from stocks which have the highest dividend yields and dividend-paying stocks, perhaps the stocks which are growing in dividends the best. Well, no, because they want to be like the rest of the market. Do all sectors actually pay the same in dividends? No, certain sectors pay much higher dividend rates. So if you were individually choosing to go for stocks which have high dividends, you could already look at, say, property management, energy, mining. Some of these stocks pay huge dividends, other stocks in the ASX 200 don't. We know certain sectors which do. The name suggests that they're actively trying to find the best stocks that are giving you the best dividend yield. Is this what they're doing? No, they're not. They're trying to be like the ASX 200, right down to keeping in the exact same sectors. And that is what you're paying your management fee for. Additional portfolio diversification by holding a permanent allocation to an exchange-traded fund that seeks to track a broad-based Australian equity index. So hang on, I've got this high management fee and yet they're trying to be the index in disguise, essentially. What's going on here? Is this typical? Yes, the answer is it is typical. The sad reality is that actively managed funds typically underperform simple ETF indexes. Why? Well, the management fees are higher, so remember that has an effect. And also often the management is not as smart as they think they are, and they tend to underperform even without fees. So what they're doing now, actively managed funds more and more, and this is industry-wide, are becoming more and more like index funds. So what they do is they sneakily hold basically an index fund underneath, and they do a bit of fiddling on top, and more, if you can't beat them, you join them. Personally, I would prefer to buy the ASX 200 an index fund rather than what I'm seeing here. And if I particularly wanted to harvest my own dividends, then I would buy direct stocks myself. I would choose from a larger universe rather than the ASX 100, and I would have selection criteria that do not force me to have the same sectors as the market overall, because I'm likely to get the same result as the market overall. So that's my thoughts on that. This was a question by Asda. What video triggered Asda to ask this question? Go ahead and click on it here.